I wanted to talk to you a little bit today about what a valuation is, what we go through in the process of putting together a valuation. I know that many of you in here are very familiar with that, especially if you do very much mergers and acquisition work, or even where I actually end up doing a lot of valuation work is in divorces. And in fact, I spent 3 days last week in a trial getting interrogated from both sides. So that was a pleasant experience for me. But I want to walk you through a little bit about how a valuation is performed, what we do when we put a valuation together, so you can kind of get an idea of where we're coming from historically about a business and what it takes to put all this information together. There's 3 overall approaches to value. There's the income approach, the asset approach, and the market approach. It's not any different really than thinking about the appraisal of your home. A real estate appraiser is going to go through a similar exercise. We're just doing it on an ongoing business rather than in a context of real estate. In fact, oftentimes when we're working on valuing a business that has real estate included inside the business, I'm going to need to get a certified appraiser, real estate appraiser, to come in and do that for me, because I need that additional expertise. I'm not qualified to opine about the value of real estate. I don't have that kind of training. But typically in a real estate appraisal, most of the time what you see, or most of the time what we think of, is really an appraisal that's based on market approach. Typically they're going to go out, they're going to look at your home, they're going to try to find other homes that were really similar to yours, that have sold within the past 12 months, typically 6 months if they can get it, and the comparison is going to be among those homes that they're able to value. In a business valuation, more often than not, it doesn't work that way. More often than not, it works out to be the income approach. And we typically work off the income approach because a lot of times when you're valuing a business, you don't have other information about businesses and the sales of those businesses, especially recent information, at least on a small business type of context, because that kind of information isn't typically public record. It's rarely ever published. There are some sources of that kind of information. Pratt Stats is one such source that keeps track of brokers that report information about transactions that they've done. But it's a rare event that those things are recent. It's a rare event that those things so closely match the type of business that you have, because every business is really a unique entity, especially in a small business context. So more often than not, you're going to end up in an income approach. The adjusted net asset value method, which is the asset approach, typically most businesses are not going to be falling in that type of value. It's going to be something where that's going to be the floor value. A business can't be worth less than what all of the individual assets, their fair market value of those assets, less the fair market value of any liabilities that are outstanding against those assets. It can't be worth less than that. If you're going to sell the business and it doesn't have any going concern value, it doesn't have any goodwill, you can always just lock the door and put a for sale sign up on the asset, sell the assets, pay off the debts, and that would be the minimum that it would be worth. Talking about the income approach, as I said, since that's where we end up most of the time, I really want to focus in on how we work this income approach to determining value. What we do typically is we look at the cash flows of the company. A business is worth basically the discounted value of all the future cash flows that are going to come to it. So if we could figure out some way to determine what all the future cash flows of this business will be forever and ever, and apply a reasonable discount rate, a discount rate being determining what the risk of those future cash flows is, and apply that to each discrete year's worth of cash flows, then we can determine what the value of that business is. Typically, what we do is we look at the past more often than not, especially if it's a business that's been around for a while and has an established cash flow. Historically, we think of that as being indicative of what's going to happen in the future. You have to be careful with that. There are two sides to this. Using the historical cash flows, if you expect that it's going to be pretty similar, you can do that. If you expect that it's not, if you are worried that it is volatile right now, or it's a startup business, or only been in business for maybe 2 or 3 or 4 years and doesn't really have a good history, we can also use what's referred to as a discounted cash flow model, and we'll work with the business owner to project out what their expectation is for cash flows for the next few years. Typically it's a 5-year horizon, or over a couple of years, that they're not going to order from you again for 5 more years. So I don't want to be capitalizing that part of the cash flow stream. Another thing that happens, by the way, and I know everybody in here is aware of it, personal things, boats, four-wheelers, motorcycles, airplanes, all kind of things land on companies' books, and those are things that I'm looking for when I'm doing a valuation, so I can factor those out. And then controlling adjustments, I mentioned officers' compensation. Another one is rent. Oftentimes companies are renting the facility from a related party. It's not necessarily owned inside the business, and that's the way I typically recommend, is that you have one entity that owns your real estate and a different entity that operates the business. And so they may be paying excess rent, or they may be paying not enough rent. So those are other things that we have to look for. Again, this is too small for you to see, and I apologize about that. I didn't factor that in whenever we were putting this together. But the adjusted income statement is the statement that I've basically created now by factoring in these one-time adjustments and controlling adjustments that I need to take into consideration, so I can come up with what is the real expected cash flow of this company ongoing in the future. Once I've determined that, one of the other things that we do, and this kind of gets into a little bit of how you can monkey with a valuation. In fact, we're doing a seminar in December for attorneys that talks about the different ways that a valuation report can be manipulated. I'm sorry? Manipulated. Exactly, that is the word. There's other words for it, but in any event, one of the things that I've done here is a weighted average. Typically, if you have a pretty solid income stream, a cash flow stream that doesn't vary a whole lot, I'll typically do a weighted average and put more weight on the more recent years and less weight on the years that are further back, so that we're trying to factor in the fact that, especially if this business is in a growth mode, or if it's in a steady decline mode, that we're picking that information up and including it in the way we do our value. So this one is actually done on a weighted average, where we just do 1, 2, 3, 4, 5, do our weighting that way, with 5 being the most recent year, 1 being the first year or the furthest back. And you have an ongoing earning power from this, which is $1,082,000. Again, I know you can't really see that, but by comparison, if I do this doing a straight average and just give every year the same weight, I come up with an ongoing earning power of $915,000. So the difference there, which is almost $170,000, when you start thinking about your capitalization multiples, which oftentimes can be as low as 3 to 4 times earnings, or as much as 20 times earnings, depending upon how this all works out and the riskiness of the business, you can imagine $170,000. If the capitalization multiple is 8, you're talking about a difference in the value of that company of what, $1.3 million, $1.3 million. So it can have a sizable difference just in whether or not we used a weighted average, or how we made a decision about that. And I've actually seen valuators do a single year and just do the most recent year. I had a case about a year ago where a valuation expert did only the most recent year. Of course, this was for litigation. Only the most recent year. It happened to be a record year for the company, and so the value that this expert came up with was about 4 times the value that I came up with by averaging over 5 years. And by the way, Tennessee Supreme Court in Blazing Game versus American Materials requires a minimum of 3 years unless you have a really super good reason why you want to use fewer than 3 years in consideration of your cash flow stream. Talked about that. Capitalization rates. This is the other area where things can get kind of manipulated in the grand scheme of things. We build up a capitalization rate for anybody that, I tell people all the time, anybody that when you took finance as an undergrad, if you were a business major and you were going through the CAPM model and you're like, I just got to get through the test, I'll never look at this again ever the rest of my whole life. This is the CAPM model, and we do this all the time. The CAPM model, basically you're building up a risk of those cash flows. You're using this to determine your multiple that you're going to apply to those cash flows, and it's building off the risk-free rate, which we use T-bills for that, which is next to nothing these days. Used to at least be 2 or 3%. Now it's like 0.25%. Equity risk premium, which we get a lot of this information from Morningstar. Almost every valuation expert uses the same materials. Size risk premium, also available from Morningstar. A lot of controversy over size risk premium. A lot of folks feel like that it's too high, that what Morningstar's publishing is inappropriate. And so even within our industry, there's a lot of controversy over this today. Industry risk premiums, also information that is published by Morningstar. And company-specific risk, which is basically my judgment. I look at things like key man discounts or key executive dependency, key customer dependencies, key supplier dependencies, things of that nature. Just things about the region, the local economy that might be impacting or affecting this business's opportunity going forward. And so I will come up with what I believe is an appropriate company-specific risk premium that goes on top of that. You add all of those things up, and that's what you come up with as your capitalization rate, and you take the inverse of that, and that's your multiple, and that's what you apply against the cash flows that you come up with. Another thing that is getting to be a little bit contentious right now is tax affecting. Tax affecting, we always tax affect the income stream whenever we apply our capitalization model, and there's been a lot of cases in the tax court where tax affecting's been done, it hasn't been done. There seems to be a leaning now towards not tax affecting S corporations. This is something that comes up between C corporations and S corporations, pass-throughs and companies that have to pay taxes. And historically, we've always tried to take that down a notch when we were tax affecting even an S corporation to try to build in factors that you don't typically think of. Like, for example, in an S corporation, all of the tax or all of the income flows through to the individual shareholders through their K-1, same as on a partnership. But the S corporation doesn't necessarily have to distribute its earnings to you, and it doesn't necessarily have to distribute enough earnings to you to cover what your tax burden will be. So especially if you're in a minority interest position, you might be burdened with taxes that you don't receive the cash flow to pay those taxes. And so that's an additional risk. We're trying to work through in our models right now a way to take that into account inside the risk, inside the capitalization rate, rather than applying an additional tax effect to it because of all the controversy that's happening in court. But there are several cases on this where the court has gone both ways. I've seen experts go in different directions. There's one, I think in Adams versus Commissioner, or I can't remember which one it is, but both experts, the IRS's expert and the state's expert, tax affected, and the one that was working for the IRS said that he felt like they had probably both undervalued the company by tax affecting, so the tax court just went with the value that was highest, where the discount was the least as a result, which happened to be the IRS's expert in that case. One other thing, and I will close, I believe, after I get done with this. Professional goodwill versus enterprise goodwill. This is another thing that has become not really controversial, but it's really a lot of times difficult for people to understand. Professional goodwill is, at least in the marital estate, and at least in Tennessee, is something that you can't really subdivide. You can't make that part of a marital estate. And oftentimes I run into a lot of problems dealing with this particular issue in that folks will look at, for example, a medical practice and say, well, this medical practice has goodwill, this doctor is well known, and so on and so forth. Well, that goodwill is really a part of his license to practice medicine. It's not something that is something that can attach to a marital estate. And so we run into that a lot. You can get into situations where you have a hybrid of that and enterprise goodwill. Of course, enterprise goodwill being that goodwill that is a part of the business itself. You're not dependent upon a particular person or a practitioner in order for that business to continue to have goodwill. And probably one of the best cases I can think of to illustrate that is Witt v. Witt, which was up in Nashville several years ago, a divorce case where Dr. Witt actually worked for the VA hospital, and he was a radiologist. He opened a radiology clinic close by, I think in Murfreesboro, if I recall correctly. And he would work at the VA hospital in the day. He had folks that ran his radiology clinic in Murfreesboro. They did all the diagnostic tests during the day and left all the films for him to review at night. He would come in at night and review the films, do his reports, dictate his reports and whatnot. He and his wife got divorced. He claimed that the radiology practice that he had was his own, it was his personal goodwill, and it couldn't be part of the marital estate. The court found that, in fact, the services that were being provided in the day were enterprise goodwill. And so the portion of the cash flows attributable in that business to the production of the diagnostic imaging and things of that nature that didn't have anything to do with his actual reading of those images in his reports were suitable to be counted as cash flows for enterprise goodwill calculation. So keeps things interesting. Really where a lot of this came out of actually is from attorneys. If I'm not mistaken, Smith v. Smith was attorneys, and that was where the court came out and said you really can't have goodwill in a professional practice. And that's where it all got started. But as a practice gets larger and larger, it gets harder and harder to say that there's not really enterprise goodwill that is separate from the professional.